Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got a market recap. Chris is back. He's the CIO of Ascend Interplay Family Office. He's got a terrific investment background. He's actually just back from Macau, where he gave a pretty large keynote speech to 200 global scale families. And he shares his perspective on a recap of the first half of 2024, both within the US and globally. I hope you enjoy. Welcome back, Chris. How's the jet lag?
Jet lag, fortunately, has passed, and
That's good.
sickness as well. But I'm still gaining my energy back. It's been a long trip in Asia.
Chris was out in Macau. There's a huge conference, which is the equivalent of the CES conference that we have in Vegas in January, but their equivalent in Macau. Tens of thousands of people. And there was a wealth track. Chris was one of the keynote speakers. 250 something people listening to him spit wisdom. I think they had David Beckham come on stage as like a follow-up for you, right? Like he was there as a supporting act.
Just side act, not important.
Right. How did it go?
It went well. I mean, the big conference is hosted by some high-profile families and the Macau government, who is trying to effectively diversify their holdings away from just casinos and attract more talent and resources to Macau. The wealth track was actually very good. We had over 200 global families, dynastic families all over the world, and coming together and trying to get a sense of where we stand in the world from a macro perspective, allocation strategies perspective, and generational transitioning. Got good family governance, and all really important topics that were discussed behind closed doors. I love these events. I think that's really how you communicate, and with the consensus that sort of it's not a public event, and you can really trust the folks around you who are going through similar struggles. And it was very successful. I enjoyed my chat. I was unfortunately very sick, and during it, I chucked three medicines, 3 different pills, going up stage, trying not to cough, and I think I did okay there. But the moment I got off stage, I was in a bathroom throwing up and trying to get myself together. It was not the most fun in it.
But you made it happen. It looked good.
Yeah, it's good.
Good polish. What did you cover? Anything that is topical for today?
Yeah. Look, I gave a, we covered a lot about the topic that I was on the panel of is global asset allocation, global strategic approach to global asset allocation. So we talked about the current environment that we're in, not just U.S. but elsewhere, geopolitics, and really just how to really best approach. If you're setting up family office, how to best approach and how to start it, and what are some of the asset classes and maybe forgotten corners that you should be aware of, and some takeaways, important lessons, and just things good to have in mind as you set up shop. So, but today I really want to frankly give an update on macro, because there's just been so many things that happened.
Yeah, let's do it.
And we're also walking away in summertime, and people are on vacation. So this is a bit of a wrap up to what's happened in the past couple months. I'll start with, as usual, a few important data points that came out, and these are certainly market moving and set a trend for the second half of the year. Everyone has been talking about the non-farm payroll, which is the job data that came out last Friday, first week of June, basically. And this is data is on May. And this data is mixed bag, for sure. On one hand, the U.S. economy added a lot of new jobs, 272,000 to be exact, which beats all projections from economists. However, unemployment rate actually picked up to, for the first time in a few years, 4% from 3.9% last year. this is more of a psychological barrier. We've been in the 3% range for effectively throughout this entire pandemic cycle. And for us to be in 4% for the first time in a while, people are paying attention. And this is exactly what the Fed wants to see, not from adding, sort of adding all these jobs perspective, but from the unemployment rate perspective. Not because they want the U.S. economy to not do well, but so that they have the bullet to start cutting interest rates. But it was a mixed bag because of the next data, which is the average hourly earnings, which we always talk about. This thing is still red hot, and hourly earnings grew 0.4% from last month, or 4.1% year on year. So again, as a proxy to spending power, what you want to see is this hourly earning to be slow, the growth of hourly earning to be slower than inflation, which is not true, right? So it's at 4.1%. We'll talk about the CPI data that just came out, basically less than 24 hours ago. The headline is it's lower. Inflation is running lower than job wage growth rate, which means your spending power as a proxy is, as a consumer is going higher. And that's a leading indicator for longer term inflation. So if you have more money to spend and less reason to save, you're going to spend it, and that's going to drive inflation further. So, and that moves market in a fairly significant way, at least in an interest rate world, which I'll get into. So non-farm payroll is a mixed bag. CPI, which just came out, as I mentioned, again, across the board, it's actually slightly below expectation, which is what you want to see. So headline CPI is now at 3.3. Core is at 3.4. Month on month growth is flat, right? This is, again, basically the lowest level since the start of this whole saga. But the key point here is it's lower. However, it's going very, very slowly lower. It's not up to speed of what the Fed would want. So you've got still have a relatively high, I would say medium level inflation going just marginally lower on a month by month basis. You've got a mixed bag on labor data, which is showing that it is relatively strong and giving consumers more power to spend money. That's not good for inflation. So if you're the Fed, what do you do? That's the conundrum they're in. Do you risk the economy by holding rates where they are, holding rates steady and not cut? Because we can all agree this is the multi-decade high in terms of interest rate, and it's not good for business. Or do you risk inflation by cutting? That's the conundrum they've been in for a while now. And sure enough, we had a FOMC yesterday, which is the Fed meeting where they may make decisions on these things, and the Fed very expectedly did not cut any interest rates. That's what the market expected. And what the juicier part of that meeting is when they release their projections going forward. And now the Fed officials are expecting as a median result, sort of one cut by the end of the year. Okay, this is a pretty major adjustment from prior meetings where they started the year with 3.4 down to 2, and now it's at 1. And at this point, bring their expectation to be fully aligned with the market expectation. Market also expects one cut by the end of the year, generally in Q4. So sometime between September and November. So that's where we are. I think we're, and to summarize all of that in context, and I've been saying this from the beginning of the year, if you're an equity investor, if you're just sort of looking at broader markets and ignoring all these noise, I think we're still in a market that's very supported by the Fed, because their intention is to cut, not to hike. And when that happens, it's better for the economy, and it's cheaper borrowing costs for all businesses is, generally speaking, a good thing. So, and I'm personally putting my money to work in the public equity market and have been doing that since the end of last year. And that's going well. And I think, in fact, S&P just made new highs yesterday. And it continue to likely to push that until the major risk factor comes in, which is later this year. Call it the election cycle. So that's my view. I think the market will go steady until then, because there's not expected to be any major event coming out of the Fed or any sort of economic data. Of course, there are the tail risk events that are happening elsewhere. But assuming all things stay where they are, equity markets should stay fairly supported and likely inching higher towards the election.
This is a very different narrative, just to time box a little bit, than a year ago, 2 years ago.
Yes.
We're now talking about, there's moving parts here, but it's evolution
Yes.
versus revolutionary chaos, right?
Yeah.
And, layers of uncertainty.
Yeah.
This is, how do you surf a strangely shaped wave? And, is it a little up? Is it a little down? It's more of a nuanced evaluation of the market, kind of on all parties, versus people just trying to get a hold of things and figure out where the hell they are. So the takeaway for me is, there's, even though it may not be fully contained, the economy may not be contained or controlled the way the Fed might want, we are in a pattern of greater degree of stability than the chaos that ensued before this.
Absolutely. And the regime change definitely happened, call it end of last year, when, again, this is all very much macro driven in retrospect. It's the moment the Fed decided to change their views, all things turn around. And so that's an unfortunate data point to the overall narrative is, these companies' fundamentals are not supposed to be driven by macro decisions, but they are. And especially from a investor perspective, and what's moving markets. So it is important to, jump back out once in a while just to evaluate where we are in the cycle. And right now we're in a cycle that's maybe calm before the storm, but at least we have some confidence going into late Q3, early Q4, the market will relatively be calm and steady and likely trending higher.
Can we just talk about the skeletons for a second, or the landmines that might be coming up? I mean, the black swan situation, or tail event, as you said, something you can't anticipate happens. There's a new war that breaks out. Okay.
Yes.
We're not going to predict those here. And if we could, by definition, they're kind of not the tail events we should be worried about.
Yes.
What are the things that we know are out there? I mean, the one that I keep bringing up is you've still got this commercial real estate issue. What are the areas that the wrinkles that haven't really got ironed out yet?
Yeah.
That could disrupt things. And are there a lot of them, or are they going away? What's happening?
Yeah, I'm going to start with the actually most obvious one, which is election. And this is the one, it's truly a potential dark horse event here, because right now, if you look at any poll, any data point, it's effectively a split between the two candidates of the parties. And some say maybe Trump is slightly ahead, and some say Biden's slightly ahead. But the reality is that prediction, all the polls, they're all within the confidence interval of each other. So there's no clear answer who's going to win. But the important part is, actually, from a market perspective, whoever wins doesn't really move the market, because their economic policies, believe it or not, at this point, are not that different. And even if they are in certain areas that are supposed to be Mark is fully pricing in a split Congress. Okay, there's not supposed to be a blue or red wave either way. And that is the key risk point. If 2-3 months from now, anything changes, that market now start to believe, even pricing in probability of a one-party Congress, then these economic policies and rate and tax cuts or continuous spending by the government, these proposals by these presidential candidates will then start to be priced into the market, and that's what will really drive market outcomes.
And this is what you're saying is a tail event, right? Because if it just kind of goes as planned,
yes,
where it's one of the two candidates and there's a degree of gridlock everywhere else, it's all priced in. We're talking about a candidate not being able to run, right? Or something happening that changes public sentiment in a massive way, one way or the other. So we're talking about tail events. The current course, though, which is a headline, is a lot of people are stressing about this election, is at least economically, the signal is the predictors are saying it doesn't matter.
Yeah. It doesn't matter on who wins the White House, but it matters a lot more who wins the Congress, and that's the big thing. And then, frankly, there's people think there's a lot of clarity in that. personally think that things can be disrupted there more easily than what the market is pricing in here. So that to me is not, I would say, a tail event, and there is some real risk there, and in at least having a close call, and that's enough to really call it disrupt market sentiments.
Okay.
So that's one. And two, for like what you said about commercial real estate, and this is very much correlated to what the Fed would do, and that's the key point here. And the Fed knows it, right? They don't want the real estate market to collapse as much as they've already done. And so what they want to do is, again, this is yet another incentive for them to start to lower rates, and which then allow these projects to be refinanced at a cheaper rate. If they manage to do that, let's say manage one cut in, maybe a couple of cuts by the end of by mid next year, that's going to alleviate a lot of the pressure in the commercial real estate. 2024 in that market, 2024 is the biggest refinancing year we have seen in a decade. 2025 is a close second, right? So this year pain is being felt, but next year these things are cumulative. So 2025, if rates are still this high, that's going to cause a lot of trouble to the market. So I think that's still a big whale of a risk coming into the economy. But the outcome of it is very much dependent on what will happen in the upcoming few FOMC. So it's difficult to say. But my bet is we're going to see a reasonable amount of defaults, and which creates opportunities for folks with money to come in and rescue and potentially invest for longer term. And they might spread out to regional banks who actually hold these assets on their balance sheet. But the cycle is such that we're at the bottom of it pretty much. And if the Fed does their job and actually comes down with the rate cuts, this could be more of a recovery path going forward.
I'm going to yes and on that real quick, just from the private market opportunities we're seeing. This has played out so slowly that a lot of opportunistic investors have already prepared, raised pools of capital, and are ready to buy when things start to fall apart.
Yeah.
And that gives, for sure pain for equity holders who are getting screwed up on the sale and they're going to lose a lot of value. But it kind of ends death spirals for the assets.
Yeah.
And so I'm looking at this situation wondering if the investment community hasn't already pre-calibrated to be prepared to handle kind of some adverse outcomes here, whether the Fed catches up, can move in time or not. So anyway, it's an interesting moment. Just, when you have 2 years of signaling, a lot of smart people look up and they see business opportunity, a chance to make money buying low.
Yep.
And that kind of bakes a floor into what happens.
Exactly. There's one more thing I want to touch very quickly, which is this big news around China and EV. We haven't talked about China in a while, so I thought it's interesting to just at least cover it. But just first to set the headline, Chinese equities and overall economy has been recovering really well this year. Okay, year to date, overall large cap index in China is up 14%. Right, so we're basically the same thing as one of the as far as major economies go, is one of the best performing. And there's news that came out, I think yesterday or so, where there's a major tariff that the European country, EU effectively is imposing on China in terms of EV and cars, because they're recognizing the dominance of these Chinese EV vehicles. And that dampened a lot of the market sentiment, because people are fearing that there's going to be retaliation from the Chinese side on European exporter vehicles, which, by the way, to all these European manufacturer OEMs, China is still one of their major markets. So within Europe, the companies are actually pushing for less tariff, but the government is pushing for more, because they are in this protectionist mindset. So that's something to mention, keep in mind, because to me, this has escalation potential to be in more of a trade war scenario that we had when let's say Trump first get it in his first presidency term. This could be one of those triggers that led to that. But overall, I see this as still a relatively low probability. I do think China will retaliate, but hopefully not in this broad stroke way, but more targeted industries that will incite pain, but and doesn't affect the overall market as much. To me, it is the wrong move. I think just the dependency, China is still the lifeline of a lot of these European country economies at this moment. And to do that at this juncture, as the economy is recovering, and is a very difficult thing for themselves, less so for China. So, and there's that news. But overall, that side of the world, economies are recovering very much on the other side of COVID, and consumer spending is going higher. All the data that come out show a strong resiliency in the economy. So it's something to be aware of. As if you're a global asset allocator, long term, that is still a very attractive part of the market to look at.
Yeah, I think I don't have a full understanding of the Chinese economy arc for the past year. I've heard it struggled and now it's recovering. Is there a super high level story about what was happening? Because we get these bits and pieces, but it's not woven.
Yes,
it's headlines.
So the economy itself is not fully recovered. Not even close. There's still bubbles and still sectors that are being hit that are still at the bottom, like, for instance, real estate. The tech industry, the tech economy, and the consumer product economy have recovered fairly well. So, and those are the real large cap that are driving the index upwards. So, and it's not overall everything's recovered, but there's sectors that are showing signs of strong recovery. And these sectors are the ones that contribute largely to GDP and to market cap of these large companies. So you're seeing signs of a recovery. But the broader headline is, of course, it was hit really badly during the pandemic because of policies and lockdowns, and all of a sudden everything was free, and people almost overnight forgot about what happened and just went back to their lives and start spending. Not at the level of pre-pandemic yet. If you look at the saving data versus spending data, people are on a household level, on average household level, people are still saving more money. This is an important point. People are still saving more money than what they used to before the pandemic, right? So it's so one minus that is basically spending, which means they're spending less as a percentage of their income versus before the pandemic, but much, much, much more than, as let's say, at the peak of the pandemic. And that's ultimately what's driving the economy and GDP going forward. So that one data point seems to me that it's still on the recovery path, but is doing better than before.
That was a hell of a recap of the first half of 2024. Thank you, Chris.
Always a pleasure. Thanks, Mark.
Quick reminder for everybody, Chris is an SEC registered investment advisor, and nothing he said should be misconstrued as investment advice. As always, Chris crushes it. Glad to have him on and get more perspective. And we're constantly talking about all this stuff, and I'm learning from him and vice versa in the office. But always beneficial to kind of sit in these academic-y settings on the podcast and get a little recap. So this is as much as for me as for anybody. So I hope you enjoyed it too. And with that, we'll catch you soon.